Hello everyone. In my previous video we have discussed about the one of the important ratio in the stock market price analysis, stocks price analysis, that is the PE ratio. So we have discussed like what is the PE ratio, how do we analyze the PE ratio, and how do we decide on the basis of PE ratio whether an stock price is overvalued or undervalued. We discussed about its interpretation, analysis, and we discussed about its limitations also. So if you have not watched that video already, I recommend you go and watch that video first before you come to this video, because in this video we are going to discuss about an enhanced version of PE ratio, that is the PEG, price earning to growth ratio. Okay, so please go and watch that video first so that you can get a better understanding about the PE ratio, and then it would be really helpful for you to watch this video. Yeah, so before I start, like if you find my videos useful, so please subscribe to my channel and like my videos. And I would request like if you can leave some comment, like if you want any improvement in my videos, or if there's any topic for which you want me to prepare a video, please leave the comment. It will help me to improve my videos. Also your words will motivate me to make more videos. Okay, so let's start today's video, that is about the PEG ratio. PEG ratio is price earning to growth ratio. Price earning to growth ratio. So in our previous video when we discussed about the PE ratio, right? So one of the limitation of the PE ratio was that PE ratio does not consider the growth. It does not consider the growth of the company. That was one of the limitation. So to remove this limitation, the PEG, price earning to growth ratio, was invented because it considers the growth factor. Now how does it consider, and how does it help in analysis? Let's understand using an example. So let's take an example of two companies, the company A and company B. Company A has current market price of 300 and company B is having current market price of 360. The EPS of company A is 20 and EPS of company B is also 20. So now what would be our PE ratio? So price upon earning, current market price divided by earning per share. So 300 divided by 20, it will be 15, and here it will be 18. So PE is 15 here, 18 here. Now what do we understand from PE? So basically at a very basic level, what we understand, in order to earn $1 of revenue, in order to earn $1 in this company, an investor need to invest $15. In order to earn $1, investor need to invest $15. And in order to earn $1 in this company, investor need to invest $18. So in order to earn $1, $15 need to be invested here. In order to earn $1, $18 need to be invested here. So when we see this way, so we feel, oh, this company is a bit cheaper, right? Because just by investing 15, I'll earn $1. But here this company is a bit expensive because here I have to invest $18 just to earn the same $1. So that's how if you analyze those, then you will feel this is expensive, this is cheap. Then as we have seen in our video, we analyze further to understand what are the reason why this company is having the high PE, or why market is ready to pay more premium. Here they are paying 15 to earn $1, but here market is ready to pay 18 for $1 in this company. So why? Then we understand there might be a reason. There might be a reason that this company growth rate is good. There might be a reason that company's growth rate is good. That's why market is ready to pay the premium. So if we know this, that if the growth rate is good, then we can justify, right? Okay, that premium is okay, right? So that is our further analysis. But the problem is in the P ratio, we don't consider the growth factor. That is just after analysis to know why the P is higher or why the P is lower. We consider the growth factor also. But in the formula as such, there is no growth factor included. So that was the limitation. Now, in order to solve that problem, so this PEG ratio was invented. So let's say if we have the growth. So growth means what's the growth in the earning of the company. So let's assume that the growth rate of this company is 12%. earning will grow by 12%, and in this case earnings will go by 19%. So if you compare this way, so this 19%, like, is this company growth rate is higher, and this company's growth rate is not so high, like compared to this is less and this is more, right? So now we need to consider, okay, if we see the growth factor, if we consider the growth factor of both the company, is this P justified? Is this P justified? Since this company is growing faster than this company, so is this P justified? So to understand that, what we do is, like, we do PE ratio divided by growth rate. So what I'll do, 15 divided by 12, that will be 1.25, and here 18 divided by 19, I think somewhere 0.95. So now this will be the PEG ratio. So now what we understand from this, previously what we understood, in order to earn 1 I need to invest 15, in order to earn 1 I need to invest 18. But now when you take into the growth factor also, when you take into the growth factor, what you understand is, in order to earn $1 in this company, I need to pay 1.25 times of the earning. In order to earn $1 in this company, I need to pay 1.25 times of the growth, right? Here, in order to earn $1, I need to invest 0.95 times of the growth rate. Considering the growth rate, I need to invest 0.95 times. Here, considering the growth for $1, I need to invest 1.25 times. So obviously when you consider the growth rate, then you get a clear picture. No, then in this case, this company is expensive, because considering the growth, if I consider a growth, I need to pay more money in order to earn $1. And considering the growth here, I need to pay a bit less money to get $1 return. So when you consider the growth, you get the better picture for the analysis purposes, right? So that's how the PEG ratio is more important, because when you incorporate the growth, that's where you get the right picture whether this valuation is justified or not justified. So how do we analyze this PEG ratio? It's like, if PEG is equal to 1, it means the stock is fairly priced basically. If PEG greater than 1, like in this case, it means it's a bit overvalued, because you have to pay more money to earn $1, right? Here you have to pay around 1.25. If the PEG is less than 1, it means it's undervalued. So in this case, where it is undervalued, then that's where you have the opportunity to invest, because you know the growth is more, the growth in the company is more than uh, the growth in the company is more, which is justifying is overvalued PE, like more PE. Okay, this is the opportunity to invest. So that's how you need to analyze the PE ratio, PEG ratio. So quickly I'll say, when we were analyzing the PE, we'll just considering, in order to earn $1, how much I to invest, and based on that we were deciding. But we're not incorporating the growth factor, because now if we incorporate the growth factor, then we understand if the P is higher, why it is higher, and after incorporating the growth, what's the factor I am getting. If it is less than 1, it means it is the share price is still undervalued considering the growth. But here in this case it is higher, so considering the growth, it's the share price is higher. So in order to earn $1, I need to pay 1.25 times. So this become expensive. So that's how the PEG ratio is calculated and it is analyzed. So that's why it is said that it is an enhanced version of PE ratio, because it helps in taking the correct decision or understanding the correct valuation of the share price. Okay. So now let's understand what are the importance or usage. So basically, I think so far whatever we discussed, you already have understood, right? First is, it is enhanced enhanced version of P ratio. Since it's an enhanced version of P ratio, it helps you in getting the correct valuation analysis. It helps us in the correct analysis, or to do a comprehensive analysis. It helps you do a comprehensive analysis. Okay. And the second is, it makes the companies comparable, because earlier when we were doing the just P analysis, then we were not able to understand, or we're not able to identify correctly based on the growth factor, but as soon as we incorporate the growth factor, those become comparable and we were able to analyze it correctly. And one of the important thing is we consider the growth factor here, so that helps in the better analysis purposes. So these are the basically the important thing. So since we consider the growth factor, actually, like if you are an investor, if you are an investor if you are an investor who is like a growth investor, who are the growth investors? There are two types of investor. One is growth investor, one is the value investor. Growth investors are basically are the ones who look for the growing companies, the company who are expected to grow faster. So if you're a growth investor, you look for the companies which are expected to grow faster, and in those cases you will be looking for the PE which is higher, because the growth companies have the higher PE. So since you are interested in the growth stock, so you look at the PE, high PE companies. When you go to the high PE companies, you will further analyze it based on the PEG ratio, just to come to a certain level of confirmation, like considering the growth, which stock is better. So for if you are a growth investor, then this ratio is very important for you to do the analysis. So this is basically the importance and usage of PEG ratio. Now, are there any limitation? Yes. All the ratios are having some or other limitations, right? So that's why we have to use so many ratios. One ratio is not enough to do the complete financial analysis. So what are the limitations? See, one important limitation is growth factor, because in order to know the growth factor, you need to calculate it, right? Now the calculation, there are various methods. Some calculate based on the historical data, some calculate based on historical plus future prediction also. So there's a bit calculation there, and there are different calculation methods. So since there are different calculation methods, so that becomes a bit limitation, because different people may use the different calculation method. But the important thing is, if you are comparing two companies, you need to make sure that you use the same calculation method for both. Now the other limitation of PEG ratio is more or less same as the PE ratio, because the base factor of the PEG ratio is PE ratio, PE divided by growth, right? So what are the limitation PE has, the same will be here. So like we discussed in our previous video, earning manipulation, because P ratio is dependent on earning, right? Earning is basically accounting profit. Since it is based on the accounting profit, always it is dependent on accounting policies of the company. Now sometimes the accounting policy keep on changing, right? What depreciation method to adopt, in what cases like the expense need to be capitalized, in what cases revenue need to be deferred. All these things are decided based on the accounting policies, and if accounting policy changes, then it will impact your earning and comparability also. So since it is dependent on accounting profit, accounting policy, so there are chances of manipulation. The third thing, this PE ratio doesn't give you idea about the cash flow, right? See, whenever we talk about earning is always based on the accounting profit. Accounting profit is based on the accrual. When it accrual comes, it means we are not considering the cash flow. So sometimes companies may be having a good earning but doesn't have the required cash flow. Earnings or profit may be good, but they have challenges in realizing the accounts receivable. So they may be having some cash flow challenges, but that is not considered, or that is not depicted by the PE ratio or PEG ratio. Similarly, if the company has high level of debt, that is also you don't get an understanding using the PE ratio or PEG ratio. Okay. Now again, another thing is this PEG ratio you cannot compare or use against across the industry. It is useful only comparison within the industry. Different industry may have different earning and different PE ratio. So you can compare only within the industry, not across the industry. And the fifth and most important is the market trend or condition, because P ratio again is dependent on the price upon earning, right? Price is current market price. Market price is determined by the market. So in market, whatever the trend is going on, whether bullish or bearish, based on that it will have impact on the market price of that stock, right? So sometimes if the market is bullish, the stock price may increase. Okay, if the market is bearish, the stock price may decrease. So market trend also impact the P ratio, and in turn it impact the PEG ratio also. So these things, all these things basically you need to consider or pay attention while you analyze or take a decision on the PEG ratio. Yeah. So basically these are the overall limitation, all the things you need to consider while you analyze the PEG ratio. Okay, so I hope in this video you must have got an understanding about the PE ratio's limitation and why PEG ratio was formed or invented, and how it actually enhance your calculation or enable you to understand better considering the growth factor. So guys, if you like my video, like if you think that this video was good and if you got some clarity or understanding, please like the video. And in the coming video we'll discuss about the other elements or other types of PE ratio like forward PE and the trailing PE. So tune in for the next video, and that's it. Thank you. I'll see you in the next video. Bye bye.